Welcome to Financial Repression Authority's Roundtable Insight, where the best fund managers, economists, and industry leaders discuss the key investment issues and challenges in the current macroeconomic environment.
Hi, welcome to FRA's Roundtable Insight. This is Richard Benuli. Today we have Charles Hugh Smith, author, leading global finance blogger, and America's philosopher, we call him. He's the author of several books on our economy and society, including A Radically Beneficial World, Automation, Technology, and Creating Jobs for All, Resistance, Revolution, Liberation, a Model for Positive Change, and the Nearly Free University in the Emerging Economy. And most recently, his latest book, Pathfinding Our Destiny, Preventing the Final Fall of Our Democratic Republic. His blog of twominds.com is number 7 on CNBC's top alternative finance sites. Welcome, Charles.
Thank you, Richard. I'm always a bit humbled by your introduction. It makes me larger than I really am in real life.
Oh, no, you have unbelievable insight, great insight. And today we thought we'd explore that insight towards the China-U.S. trade war that everybody's talking about and that has been unfolding for quite some time now. And so what are your initial thoughts on the China-U.S. trade war? Why has it happened? And eventually we'll talk about also where this all goes, the end game.
Right. Great topic, Richard, and thank you for the first shot at it. I think the proper context is to go back over time, like say since the end of World War II, and examine what happened with other Asian countries that moved from developing economies to developed economies. In other words, they came from a position of relative poverty with very little credit, and then they entered the global economy and became wealthy, which is the same track that China has followed. And we find that in the 1950s with Japan and the 1960s with South Korea as two examples, that developing world economies are given a lot of slack with things like theft or borrowing of intellectual property. Like a famous kind of humorous example is in the 1950s, Japan renamed one of its industrial towns USA, so it could then say "Made in USA."
Right, yeah, exactly.
And kind of like it's understood by everybody that developing economies kind of are allowed to play fast and loose with certain rules because the developed economies want their cheap labor and they want access to their markets, and so they'll kind of look the other way about things like intellectual property theft and that kind of thing. But once the country develops to the point where it's selling, competing in the global market as a peer to developed economies, then it's expected that they will start following the same rules as the developed economies. And so I think in broad brush, that's what's being asked of China, is that it stop acting like a developing economy and start acting like what it really is, which is a developed economy, with a formidable economy, a global military superpower, and so on. So I don't think that what the U.S. is asking of China is extraordinary. It's just asking China to make the transition from developing world economy where you play fast and loose with all the rules and you actually start following the rules.
Mm-hmm. And I guess we can consider China overall now as a developed economy, even though within their country, there's sort of two Chinas, if you will. One is the developed portion on the eastern seaboard, all the cities there, quite high standard of living, and then there's the other China, which is still very large numbers, hundreds of millions of people still in the developing world state, but therefore overall you see them as a developed country.
Right. I think that's a key insight to recognize there's two Chinas in terms of the West and the East in terms of development. But if we look at it and say, okay, let's say there's 500 million pretty wealthy people in the developed eastern seaboard of China. Well, 500 million puts it, it's like, the largest nation on earth,
Yeah.
other than India, right? I mean, so it's already, it certainly should be treated as for what it is, despite the fact the West is still much poorer. But there's also two other Chinas. One is the government-run economy, right? The central planning economy, which is dominated by SOEs, right? The state-owned enterprises, and that includes a tremendous number of companies that are owned by the People's Liberation Army and other branches of the government. And then there's the free market, right, with Baidu and Tencent and all the companies that we're familiar with. And then there's a hybrid, which is Huawei, right, the big tech company that's at the center of this controversy. And just technically speaking, it's considered a separate corporation, but it has tremendously deep ties with the government. And this is one of the rules that China's broken in the WTO, the World Trade Organization, that it joined in 2000, in the early 2000s. It's required by the WTO for governments to stipulate the subsidies given to companies like Huawei, right? And so China has refused. And so it's broken the WTO, one of the critical rules. And so that's why people outside of China look with great skepticism on any trade deal that China signs, because they just don't follow the rules.
And there is a push still by the Chinese government overall to try to maintain social stability by continuing to create jobs. And whether that means creating jobs through infrastructure projects, interior to the country, or trying to create jobs for export services for exports out of the country. That seems to be a major driver in all of this. Would you agree?
Yeah, no, I think that's a good point, Richard. And I might have mentioned this in a previous program, but I always refer back to my first visit to China in the year 2000, when the official media there was full of stories about the TV production industry there was already in massive overproduction. In other words, they'd already oversupplied all of the Chinese domestic market. Everybody in China already had a TV, even if you were poor. And then they swamped the entire global demand for TV. And so this is the problem that China has, and it's had it for almost 2 decades now, which is they can produce so much that there's just no way their domestic economy can absorb even a percentage of their production. And so they absolutely need overseas markets. They need to be able to sell into the global marketplace in order to absorb or to offload their tremendous productive capacity. And so I think the situation, just in terms of just basic economic supply and demand, is China needs the global market, and it needs the U.S. market to sell into, because the U.S. is still about 25% of the global marketplace. And they need that ability to sell into the global marketplace for the domestic reason you point out. They need the jobs more than their customers need a made in China sticker on the product. In other words, and it's not just the US, it's true of Europe and Japan, South Korea, all of their markets. Nobody really cares if it says made in Vietnam or made in Malaysia,
Mm-hmm.
And so they don't really have any leverage, given the fact they really need that that the domestic marketplace isn't large enough to absorb their production. They've got to sell into the global marketplace, and that's that weakens their hand really in trade negotiations.
And overall, what are your thoughts on how this will affect the relations between the U.S. and China in terms of what's happening now with the geopolitical issues as well?
Right. And again, my context goes back to what's expected of a developed world economy that's actually has aspirations of being a superpower, that is China. And I think the Chinese are acting a little bit like, poor me, like, why are you guys asking these difficult things of us? And I think the reality is they're simply being asked to follow the rules that every other developed economy has to follow. So I think that they're going to have to come around to that as being reasonable, and not, it's not blackmail or anything. It's just simply the way the world works when you reach the status that they have. And so I think that process is probably going to take about 6 months. And of course, the U.S. would benefit too from like stability, geopolitical stability, and economic stability by cutting a deal with China. But I think that even though the U.S. is the lead economy in this sort of trade war, I think that overall, Europe and Japan and South Korea and the other large economies, I think they're basically in agreement with the U.S. that they're not asking China for anything extraordinary. They just simply want China to start following the same rules they have to follow.
Now, you've graciously provided some charts that we'll make available on the website to help understanding on this. Can we look at those and then go through each one and how it relates to the trade war?
Right. Well, I think maybe I can let you speak to the two that relate to debt. One, the surge in global credit, showing that China has created much of the debt globally in support of its domestic economy. And the other chart here we have of total debt and GDP, which shows that China's debt has risen at far faster than its GDP. Like, in other words, there's a diminishing return on additional debt. And so you go, why is China borrowing so much money? And you had an answer.
Yeah, is this going more into infrastructure, like real estate type projects interior to the country to try to create jobs to maintain social stability?
Right, exactly. That's the price they're willing to pay to keep full employment.
Mm-hmm.
The two other charts here we have is the changing nature of China's trade with the world. One is we have China Import Price Index, which it shows that it's declined significantly here. And the other one is the current account balance, which is a way of saying China's trade balance with the world, both imports and exports. How does it work out? And of course, they're running a very large trade deficit with the U.S. In other words, the U.S. Is running a deficit with China. But if you add all of their global trade together, then their global trade is approaching the zero line. In other words, they're not running huge surpluses anymore with their trade. And of course, a lot of that is energy. Their energy use has soared, and so they're buying tremendous amounts of natural gas and oil to support their booming economy. And so that's changing the picture in a fundamental way. They're no longer able to live off of surpluses. And there's another point here, which is that a number of analysts, including like Kyle Bass and some other people, are talking about a US dollar shortage in China because they've borrowed a lot of money denominated in dollars. And so the point there being, a lot has changed fundamentally in the picture of China's trade and economy over the last decade. And then we also have here a chart of household wealth. And in the U.S., it says like about 28% of household wealth is in real estate, but in China, it's like almost 75%. In other words, household wealth is really asymmetrically concentrated in real estate, which means that the China's domestic economy is particularly vulnerable to any kind of disruption, like say a credit bubble burst or some kind of financial crisis that would bring their real estate bubble back to earth, because that would have a tremendous impact on household wealth and household spending and so on. And then my last chart here is one of my favorites, because it shows the U.S. dollar share of global payments, loans, and reserves compared to the other major economies, Europe, Japan, and China. And if we look at this chart, we see that China's yuan, also known as the RMB, renminbi, China's official currency, is a sliver of any of these. In other words, it has no global role compared to the U.S. or Europe, and even Japan's role in terms of its currency is basically trivial.
Mm-hmm.
In terms of the use of payments and loans and reserves. And so for China to claim superpower status other than military, which of course is weak, because that's exactly what the Soviet Union did too, right? It claimed superpower status militarily while its economy turned into a shambles, and it took down the entire nation state. So military superpower status is contingent on a lot of other things. What you really want is you want a global currency, and China doesn't have a global currency. It's pegged to the dollar, and so it's really dependent on that peg. And I don't see how they can ever really claim superpower status if they don't allow their currency to float freely, which means that they'll no longer control its valuation. That will be decided by the market. And apparently, I guess we can conclude their unwillingness to let it float means that they're afraid of what would happen if the RMB was allowed to float. So these are issues that China's economy and trade situation has changed dramatically in the last 10 years, and yet they're still pegged to the U.S. dollar like a developing economy, and so they're going to have to go through some major transitions if they're going to become a superpower financially and not just militarily.
Do you think at this point China prefers a weaker currency or a stronger currency? So maybe a weaker currency to help and facilitate exports as they have done for many years, or a stronger currency to help their direction strategy in terms of trying to make the domestic economy stronger, more of domestic consumption? Which way do you think?
Yeah, that's a great question, Richard. And I think they're really on the horns of a dilemma here, because, as you say, if their currency strengthens, they're able to buy more energy, with the same units of currency. So that would be beneficial, and their domestic populace would be able to buy more goods from overseas. But that would hurt their competitiveness as a producer, right? As a producing economy, because then their goods would become more expensive. And then so I'm not really sure. I think their strategy has been wise so far, as they're trying to kind of thread the needle there and balance those two, so that they're not too weak and their currency is not too weak or too strong, that any move in a major way would upset the apple cart. But they also have another issue, which I think is underappreciated, which is their labor costs are rising dramatically. And so China is no longer a low-cost producer. And so, clearly their strategy in China 2025 and so on, their strategy is to move up the value chain, which is exactly what Japan and South Korea did as their labor costs rose, is that you start creating more value-added products so that you can afford to pay your workers higher wages. But that's a wrenching and difficult transition. And not every economy in the world has made that transition successfully, especially in a period where I think we can anticipate a global recession. We can anticipate credit bubbles bursting and a kind of negative macro environment for China's transition. So I think they have those are profound challenges that every nation faces when it transitions from developing to developed.
Hmm. And what about on the big question, the potential use of the so-called nuclear option? Do you think that they would consider and actually do a selling of U.S. Treasury bonds?
I'm glad you asked that, Richard, and I know this sounds like possibly a supercilious answer, but I always respond when people bring up the idea of China selling its $1 trillion in U.S. treasuries like in one fell swoop. And the idea being that would crush the treasury market and disrupt the U.S. economy and so on. I point out to people that the Federal Reserve already printed almost $4 trillion out of thin air. So they could easily print $1 trillion and buy the entire Chinese holdings if they chose to do so. There's nothing restraining them from that at all. I also would point out that, we all know the Federal Reserve and the Treasury, U.S. Treasury, work through proxies. And some of them are pretty laughable, like some entities in Belgium, buy hundreds of billions of treasuries and, the Cayman Islands and, so I think it would be very easy for the Federal Reserve to use to create whatever funding was necessary and supply its proxies who would then buy hundreds of billions of dollars of the treasuries. And there's a dollar shortage around the world. Again, a lot of people have spoken to this. And so and there's a lot of demand for U.S. treasuries, which I think we can see that the yields have been dropping all year. And I think in one of our previous conversations, you mentioned that Martin Armstrong has projected tremendous inflows of non-U.S. capital into U.S. capital markets for a number of reasons. One of which it's just a safer haven than other currencies. And so I really don't think $1 trillion is that much anymore. Frankly, I know that sounds again sort of cavalier, but I'm sorry, $1 trillion is just not that much in the treasury market. If they dumped it in like overnight, it would probably cause a flutter for a week. That would be my prediction.
I see. Interesting. And how do you see this overall playing out at this point, especially given the Asian culture to try to save face? So, given that the U.S. has taken a very hardline, confrontational approach to China, has that caused, or will that cause China to lose face, and therefore could there be difficulty in coming to an agreement based on the cultural factors?
Well, that's a great observation and context, Richard. And people, our listeners may not know that both you and I have a pretty long history of experience in Asia and Chinese culture. We won't have to go into that, but it's just that we're not we're pretty sensitive to that ourselves. And so I think the situation is. From what we can gather, and again, we don't know what went in the closed doors, but apparently President Xi of China ordered his negotiators to more or less tear up a lot of the agreement because he had calculated that President Trump would cave in and agree, and that was the miscalculation. And so I think that in terms of like who was responsible for the thing falling apart, it seems pretty clear it was China. So, but I think the positive news is that Trump's, very, sort of insensitive response has kind of reset everything to zero. So what I foresee is Trump making some kind of overture, which is not uncommon for him. He'll often kind of bully or bluster and then come back with some sweet talk. And so I see him making an overture to President Xi of China, and then that would enable President Xi to respond, without losing face. And so I think we're going to see that happen probably within a matter of weeks, certainly within a couple of months. And I see a deal happening later toward the end of 2019, because the benefits to both countries are just really, sort of like obvious, if you will, and profound. So I think that both leaders are going to want to cut a deal for their own benefit and for their benefit of their own economies.
And would that deal be beneficial to both economies or skewed to one?
Well, Richard, it's a great question, and of course, I am only an observer. I don't have any inside information, but I think it's to China's benefit to agree to follow the rules. I mean, China has a formidable economy. They don't really need these kinds of to flaunt the rules. They don't really need to steal intellectual property and ignore the treaties that they've already signed. They can prosper very well by following the rules. So I think it's actually to their benefit to just go ahead and agree to these very conventional. Everybody else follows these kinds of treaties, right? And so I don't think they need those kind of breaks that they've been getting. So I think it's going to benefit both economies. Competition is always good. And so as China competes in the global economy on a level playing field, then it's going to strengthen its own industries by letting them compete openly and following the rules everyone else has to follow.
And so what is the message for today? Can you summarize? Is it China is in a position of weakness and we get a trade deal by the end of the year? What are your thoughts as a summary?
Yeah, I think that's a very good one. I think if the global economy is slowing, which there's so much evidence for that, then it's a matter of both the U.S. and China will benefit from closing a trade deal this year as the global economy weakens. But I think the pressure is more on China, both as their economy will weaken to a greater degree than the U.S. economy, and also because they really need to step up and start following the rules. And that's not asking of them any more than is being asked of any developed economy. So I think that's the sort of summary.
Well, that's great insight, and on this very hot topic, everybody's talking about it these days. How can our listeners learn more about your work, Charles?
Please visit me at of2minds.com. Free samples of my last few books and lots of free content.
Great. Thank you very much, Charles.
Thank you, Richard. Great topic.
The FRA Roundtable Insight Show is for informational and educational purposes only and should not be considered as a solicitation or offer to purchase or sell any securities. The investments, investment strategies, and investment philosophies discussed or presented on the show each involve their own unique risk factors which are not discussed on the show. Any discussions among the panel participants or responses to listener inquiries are based on the personal opinions of the panel participants and do not take into consideration the listener's suitability, objectives, or risk tolerance. Please be advised that you invest or speculate at your own risk.